Good morning. This is Diane, DNF Properties, and today is February 1st, 2023. And today was an important day because the Fed did change rates. They went up only a quarter, so they're slowing down their pace. And rates have reacted favorably, and stock market is doing well as well because they know that they're assuming that the slowdown of the increases is happening now, and maybe in the future there won't be any then maybe they'll pause. I did have some information I wanted to share to you from a marketing meeting this morning, so let me pull that up. So here's a market update for today, 2/1/2023. This is for Santa Clara County. So in our Santa Clara County, this is the stats for the week. This is on a 12-week average. As you can see in different areas of Santa Clara County, this is just a few selected areas of Santa Clara County. Listings have decreased from their average, their 12-week average, except for Central San Jose. They went up just 5% by 2 units. Blossom Hill, on average, has 23 units. They only had 16 this past week, so that's really good for sellers because there's a high demand there. There's lower than average listings, so we may be seeing more offers or interest from buyers in that area. The next slide, again, this is the rolling average for the last 3 months, and it's showing that our actives have decreased 12%. So that means there are less properties for sale. Our inventory is decreasing. Our pendings are also only off by 4%, meaning the spread between the two are getting closer. More properties are starting to sell. This is really good news for sellers. Buyers should really jump in before this changes and gets with the pendings more and more, which could happen with our low inventory. This next slide shows Santa Clara County inventory. This goes back to 2019, we were at like 1,000 some units. Same time in 2019 in January, and we are now at 492. So our inventory has been going down overall. It was really low last year, but last year was a weird year, and that's when we had the multiple offers in the beginning of the year and really peaking in median price at that time as well. This shows our average listings for this is for condominiums, and for this time 2023, this time over the last few years, we are starting the year with 202 condos PUD units. This is low. Our average is 233. As you can see, 2022 had 159 units. That was really low. We were really low in 2018 because we had a really good year for sales in 2018. But our average is 233 over the last 5 years. So we're below average, so we really don't have that much inventory. The next one is the same thing, only for single-family homes. The average for single-family homes is 445. This time, we're talking January 20 of each year. Right now, we're at 439 single-family homes. That's low. Yes, we were low in 2022, 2020, and 2018, but 2019 wasn't a weird year at all, and we had a lot more units. We didn't fall off the rocks or anything here. It was just a normal year, and we had 737, so we're way below there. So I'm trying to tell you that inventory is dropping. Here we have, this is a statistics for what sold 2022 versus 2021. 2022 is a dark blue. It seems like first-time buyers are stepping up because there's a lot more buyers that have been first-time buyers than any other category. The distress sales right here. Everybody's talking about foreclosures. Only 1% of the market has been foreclosures. There's really very, very low distress sales. A lot of cash offers, though. We've been having lots and lots of cash offers. And the days of market did increase a little bit, but we're still under 30 days on average, which is not bad. This is comparing 2022 December and 2021 December. The next slide. I want to talk about what you hear on the news. You're going to hear on the news nationally how real estate's falling, doom and gloom, foreclosures, all this kind of data. This is just to show you, this is two datas that were reported on the same day, one by Case-Shiller, the other one by FHFA. They both show different numbers. One shows 7.7% annually and the other one 8.2% annually increase in prices. In the Bay Area, if you look at Pacific, it's actually decreased. Again, you need to look at your niche market. You need to look at your area. You need to talk to the professionals, the realtors in those neighborhoods, because national does not equal local. So it's really important to understand your market. When you listen to the news, you listen to Goldman Sachs saying that we're going to have foreclosures and this, it doesn't translate in data. So it might happen in some areas that are over flooded with homes, but this is not the case for Santa Clara County. This is another chart that shows you total listings. This is, again, I want to compare this chart because I have a lot of people telling me that we're going to go into foreclosures. There's always foreclosures. There's always going to be a few foreclosures here and there. There's always been foreclosures, but those bulk of foreclosures that we saw in 2007, 8, 9, I really don't see that coming. If you see here, these are the listings, active listings that we had in our board in Santa Clara County over the years. In 2007, we were at 5,707. We peaked at 6,698 in 2008. In August 2008, that one when we had our most listings in our area here, Santa Clara County. And this is going over the years, listings have decreased, the number of listings. We are at 720 through January 2023. That is pretty low. It's been low for a long time in inventory, and we've been having crazy markets for a long time. I don't see this jumping up. The only way this will jump up sky high is if a lot of people got laid off. Yes, a lot of people are getting laid off right now, but it's only like 5% of the workforce, 10% of the workforce. I haven't heard any more than that. That means that still a lot of people are employed, and a lot of people that are unemployed are being picked up quickly in other companies. So I don't see the foreclosure market taking off unless something drastic like what we had in 2007, 8, and 9 happens. And a lot of that was driven because of the bad loans that were written. And right now, the loans are good. The underwriters are really tough, and the loans that we've been writing are very, very good. And people have a lot of equity too. So if they're in trouble, they're not going to go to foreclosure. They're probably going to sell. This is Freddie Mac's. The weekly Freddie Mac has a report about interest rates. This was last week. They report every Thursday. So as of last Thursday, the average 30-year fixed loan was 6.13%. It peaked in October at 7.08%. I've been pricing people between 5 3/4 and 6. It depends on your down payment. It depends on your FICO score. It depends on a lot of stuff. But we're seeing some of them just under 6. Again, everybody's situation is a little different. We have to get quoted, but that's what the average is. So there is a slight decline of rates. It seems like they're going in the right direction, which is a great thing for buyers. And because of that, buyers have been moving into the market. We are starting to see multiple offers again in some areas. So that's something to consider. Here is another one. This is a 10-year note yield. Our interest rates follow the 10-year note yield. So the lower the yield, the lower the interest rate. So this is just to show you that we had a bottom of rates, the yield at 1.17 in August of 2021. So it was 1.17%. That's when interest rates were around 3, maybe high 2s. We were writing those kind of loans. It peaked, it went crazy from about March of 2022 to October. And it peaked, this is the yield again, it peaked at 4.28%. And that's when we were seeing rates of about 7 interest rates on the 30-year fixed. Since then, since October 2022, I'm sorry, that's 2022, not 23, rates, the yield on the 10-year note has been declining. Today, it decelerated quite a bit. 3.47% is where when I did this chart, but I think it closed today. I don't see it here. It might have closed around 3% today. So rates the yield on the 10-year note are slowing down. Interest rates, mortgage interest rates tend to follow. So if this continues, we may be able to see better rates in the near future. So keep an eye out for that. So if you are looking for a home to buy or refinancing, rates are better than they were in October, and they could get better, a little better, as we go down. Now, to get back to 3%, or where the yield is around 1%, that may not happen for a long time. This was artificially created by the by the government because of our pandemic. So they created this lower rate environment on purpose to stabilize the economy because of COVID. So I don't know if we're going to see rates super low again. You never know what lies in the future, but if they do happen, it's not going to be anytime soon, unless something very bad happens, which nobody wants. And then this last chart is just showing the January 2023 report that we added 106,000 jobs. The new report comes out February this Friday, so for the month of January. This January 23 was for the month of December. The one coming up will be for the month of January, which will be reported Friday. They're anticipating a little bit higher job growth, which is good for people. Again, they're also saying here that even though wages are reported 7.3% up, and they say people who switch jobs, again, this is the ADP employment report, their findings, that the people that switch jobs have a 15.4% increase of wages. So that's good. So they're keeping up with, the higher rates and some inflation. So that's our market update. Sorry for the lengthy report, but I hope you enjoy it. If you have any questions about it, give me a call, 408-221-6602. That's my cell. 408-270-9776. That's my office number. You can email me. You can hook me up on Facebook. Whatever you like, I'm always available to answer questions. And if you have any questions about these slides, feel free to give me a call. Thank you very much, and have a great day.